The S&P has just opened and very mixed results right across the board, but we want to bring to your attention some very big news that JD.com is down and quite significantly, and now this is due to the fact that Walmart have confirmed they are selling their stake in this company. The main reason for this, Walmart have said they want to focus their attention now onto the strong operations in both Walmart China as well as Sam's Clubs. And for those that were unaware of this, in fact, they entered into the alliance with the company in 2016, so we're talking around 8 years ago. And what's very interesting, maybe not a lot of you would have known about this, but Walmart did own around 9.4% of the shares in just that latest quarter, a significant amount, in fact 289 million. Now, when we take a look at the effect, it is down now, recovering from that 10% initial drop, around 6%. In fact, over the last year, not the greatest of performance, down 15%. And we can see right now trading in the mid to lower end of the 52-week range. What we find very interesting, both Wall Street and Quant give this a strong buy at some very high levels out of 5, and Seeking Alpha a buy of 4.42, meaning it isn't too far away from them also indicating this as a strong buy, and maybe over the next few weeks we could get our very first strong buy right across the board. So today we want to understand, is this a severely undervalued company that we believe the market has overreacted to and is definitely a massive buy now? A few things to consider. Now, the first one is that they did just release their latest earnings not too long ago, and whilst we will look at their underlying metrics, we want to point out that their revenue, so their top line figure, was only a 1.2% increase when we compare it from the second quarter of 2023, so that is in fact the same quarter from last year. And the other thing we want to draw your attention to is that they have started, or in fact continued, their share repurchase program, where they are buying a large number of shares. And as always, for those that don't know, this is a very good sign for investors, as ultimately it means they are returning excess cash and giving you a larger portion of control over the company. Now, looking at their metrics, typically we get a dividend safety score. Given this company has just started paying a dividend, it isn't one that we have today, but very nice to note, the last full year increase did sit at 26% over the last full year. Now, when we take a look at the underlying metrics, now first one, naturally they pay a dividend, so the free cash flow payout, we want to see below 60%, 20% in 22, 25 in 23, 22 over the next 12 months. So we do honestly believe moving forwards they will be able to continue that upkeep of the double-digit rate that as dividend investors we really do love to see. Now, free cash flow payout, very important metric. We want to see consistent increases over the longer term. One thing we don't get is consistency, but what we do ultimately get here is some massive growth over the long term. In fact, from 269 to 2090 in 2022 on a trailing 12-month basis at 22.8, although we do see the anticipation of a marginal drop over the next 12 months at $20. Now, one of the main questions you want to ask yourself when considering this company, do you believe that the top line revenue growth has reached its peak and has started to come down to its more natural levels? In fact, for the last 10 years, the majority we see double-digit growth, but it has been coming in a downward trend, and over the last year at 4%, that is really the bare minimum of what we want to see. Remember, on this channel, 3 to 7%, and if it's not hitting at least 3 to 4, it isn't keeping up in line with inflation. So are gone the days where JD.com shows us that double-digit growth. Something to consider and something we will look at when we analyze that valuation. Now, in terms of numerics, well, we can in fact note it has gone from 69.3 billion in 2013 on a trailing 12-month basis around 1.070, and we'll look at this in some more detail. But the main thing we want to take away here is, whilst it has been increasing, that growth can be seen to be slowing down, and as we just saw from their more recent quarter, it has just increased 1.2% from the same quarter last year. Now, also shares outstanding, what we do want to see on this channel, companies do share buybacks. As we pointed out, they've started to do this just over the last year. Otherwise, until then, they have diluted your position as a shareholder over the last 10 years, increasing those shares outstanding. Then we get to the ROIC, very important metric. We want really 10% or more to give us faith management are able to effectively allocate their capital. Now 2014 to 2018, when we will look at the income statement, they haven't turned a profit. Since then, whilst it is positive, it is pretty low. I mean, 8% in 2023 is acceptable, as well as the 9 on the trailing 12-month basis, but we really want to see a 10 at a bare minimum, and ideally want to see a bit of consistency. Then we move on to the margins in what we would consider as a bit of a red flag indicator. Ideally, we want to see 12% or more. In this industry, you could argue the likes of the big companies like Costco, like Walmart, like Target, they are sitting around the 4% level. So 3% in 2023 is really not just at the lower end, but also something we want to see continue to increase up into the double digits. Free cash flow margin as well, looking very inconsistent right across the board, just over the last few years in the 2 to 4% level. For those that know, on this channel, we want to see ideally a bare minimum of 5. We then move on to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. Now, 0 over the last 5 years is a strong signal, as well as over the next 12 months. It won't even take them 1 day to pay it all off net of cash on hand, which we will take a look at their balance sheet shortly to show that it is very, very strong. And also do understand that this metric correlates to both the dividend safety as well as the balance sheet strength, so a very good signal. Just bear in mind there were some metrics here that we wanted you to consider further when looking at your own investment thesis. Now, we also want to let you know we have released our latest free weekly article where we run through some super investors, what they've been buying and selling. And if you want to read any of these other articles as well, they are free, so you can click on the pinned comment below, take a read. And also, in fact, we have released 35 undervalued stocks for your consideration this month, where we also take a look at those that sit within our portfolio. So do check that out by clicking on the pinned comment below. Then we want to take a quick look at institutional ownership. Now, it does sit around 16%, and we do note 624 million worth of sales by the institutions over the last year, but we see pretty much double the amount of buys during the same time period. And in fact, we do have to point out that in the more recent quarter, we do see more selling than buying, although in the previous quarters, in fact, we do see the opposite. As always though, never copy what the institutions do your own due diligence. And the other thing we do want to draw your attention to is that Michael Burry, who has been loving Chinese stocks, been buying a lot, did in fact reduce his position in JD.com by around 31% just in that latest quarter, but we can still see it does make up a fair amount of his position, right now sitting at 12.31%. Now, going back to the historical performance, it is down around 15% over the last year. Over the last 10 years as well, down around 5%, so not the greatest return if you've been investing over the longer period. And in fact, we do note all-time highs of February 2021 at around $103. We can see right now the share price is pretty much sitting a quarter of its all-time high at $26. Now, as we said, towards the lower end of the 52-week range, it does currently have a yield of 2.7% and a forward P that does look very, very cheap at around 7.3. Now, as we mentioned, we want to take a look at the income statement. The top line we already addressed, very strong growth over the period, although we do want to point out, as you can see graphically, it has started to slow down, so do factor that in your own investment thesis. Then in terms of the bottom line, this is the main thing we want to look at here. As we established already, they haven't turned a profit up until 2019. And in fact, in 2021, they also had a net loss. So when we do take a look at it from a graphical perspective, you can see there is a lot of inconsistency on the bottom line. Although from the lows of 2021, they have started to move the right direction. What we want to understand is, can they keep that up with their increasing top line, even at a slow rate? And on a trailing 12-month basis, it does look like that answer does seem to be yes for now. The next thing we want to draw your attention to is the health of this company, their total cash versus their total debt. 4.7 billion in 2014, 28 billion over the latest quarterly report. So that is massive growth. They do sit on a large cash position, which has been increasing just over the last 10 years. But as always, numerically, that number will not tell us anything, which is why we compare it directionally and in fact numerically to the total debt. And what we can see here, 305 million in 2014, increased to just under 12 billion, and it has, similar to their cash, been increasing, but as we saw, their net debt to EBITDA does sit at 0, so it won't even take them 1 day to pay it all off, and very obvious, their cash does sit much higher than their total debt. Now, before we jump into the valuation, a few things to cover. First one, their earnings per share. Nice to note, over the last 4 quarters, they did beat management target, so a 100% track record. Over the next 3, they're anticipating double-digit growth to the EPS, although we do see quarter 2, they are estimating -9%. Now, if they hit their next year, December 2025 EPS estimate, the forward P will come down to around 6.87. Again, it does look to be fairly attractive just based on that metric, and as we saw at the beginning, nearly a triple strong buy rating from all of the analysts. Then we move on to some of the gradings. Now, the first one will be a valuation where they do get an A. No surprises as we have just uncovered, 7.26 on a forward P basis. Now, the sector median at 15.3 tells us right now if you are buying JD.com, you are getting a 53% effectively discount to the market, and that is what we are seeing here right across the board. Any valuation metric you use, it does show that JD.com does look to be incredibly attractive, trading at a mass discount to what the sector median currently is valued at. As always though, there are reasons why companies are down. Our point here is to spot whether or not it is justified, whether the market has overreacted, and if we should take essentially a position in these companies. Now, their growth rate does sit at C. Revenue year on year, 3.3%, higher than the sector median of 2.2. Forward looking, 3.88, again higher than the sector median of 3.7, so that is a good sign. And in fact, the earnings per share, 11.2%, that is marginally higher than the sector median of 10.7. So yes, we do get a C plus rating here, but overall we are noticing in a lot of these growth metrics, they are performing very, very well. But as always, you will need to incorporate the larger picture rather than just some metrics. And the next one we want to look at is their profitability. Now, they get an A plus overall. What we want to draw your attention to is their gross margin is very low at 9%, sector median at 37%, and on a bottom line of 2.81, that is very low. I mean, look at the sector median at 4.6. Right now, this company, in my opinion, does have some issues with their margins, which I would like to see a lot better than what we currently have. But ultimately, why they get the A+, well, the cash from operations of 10.2 billion is significantly higher than the 264 million of the sector as a whole. So this part, a quick summary, a buy rating from Seeking Alpha, as we said, not far off a strong buy, with both Wall Street and Quant considering this a no-brainer buy. Valuation A, growth C, profitability A+. Now, finally, we want to just run through how well or how poor they performed against others in the industry. We have some very big names in both the Chinese as well as the US market. And when we look at a total return, so including reinvesting those dividends, what we note here, a bit of a trend, not the greatest year in terms of the market overall, with 3 of the 6 having negative returns. And when we zoom out over the last 5 years, we can see as well 2 of them being negative. JD around negative 8%, not great as we mentioned. Over the last 10 years, negative 11%. In fact, quite a few have been negative over the last 10. Now, very important to understand that past performance is not an indicator of future. They could do a lot better, but they could also do a lot worse. Now, our intrinsic value of $51.33, we're going to run through how we got this, but as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we run it through is Graham's valuation, where we have the EPS, we have the long-term growth rate, AAA corporate bond yield, which gives us a massive undervaluation signal, the intrinsic value substantially higher than the market value. But as always, we never look at one of these models in isolation. We then have the multiples valuation model, companies in a similar sector and size, their average P multiplied by the EPS of JD, where we get another undervaluation signal, so currently sitting on 2. Now, typically we would use the dividend discount model, however, they have just started to pay dividends over the last few years, so we won't be using this model for now, maybe over the next few when we do get the consistency. And then we get the DCF model. We have the free cash flow year on year, the average growth rate, which is very high. We are going to be very conservative. Now, we've gone for negative 4%. The analyst target is higher, but we want to be very, very conservative just to show you it does look to be severely undervalued, because if they have negative 4% growth rate moving forwards, ultimately with the discount rate, when we do get the present value of future free cash flows and terminal value, we do add the cash, subtract total debt, get to the equity value divided by shares outstanding, we do see that massive undervaluation signal. So 3 for 3 today, so 51.33, just the average of these 3. And as always, we do use a margin of safety. Now, before we look at that, we do know Wall Street very bullish, as we just saw, a strong buy rating, not as high as our intrinsic value, but they see 54% upside over the next year with their price target of $40. We then, as we said, use a margin of safety, which we typically start off at 10%, execute on that if it meets our 3 golden criteria. a wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, in today's episode, a buy up to $46.20, and then we keep going until it's near that current trading price. And what we note in today's episode, there is a mass undervaluation signal. In fact, nearly at that 50%, you could argue at least 45% of an MOS if you are buying up to $28.23. So ultimately, you are getting a 54% upside according to Wall Street, as we saw nearly a triple strong buy rating with what we believe to be a very sufficient MOS level. If you are happy with some of the red flag indicators that we pointed out, you believe they will improve their margins moving forwards, as we did see it did lack, and over the last 10 years, there were many periods where they hadn't turned a profit. As always though, do give us your thoughts in the comments below. Are you buying? Are you selling? Maybe not one for you due to the fact that it is positioned in the Chinese market, or in fact maybe you see this as a very strong opportunity to add a company with a very large margin of safety. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and also join the Patreon if you do want to run through our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.